Claudia, when I say go beneath the headline data, where does Claudia Sahm go beneath the headline data?
Well, I mean, the first place that I went to look, seeing the unemployment rate tick up, which is a tick, not anything to get too worked up about, but just to see what was happening with labor force participation, if that can kind of be the good reason to explain it away. And that doesn't seem to be what's going on there. So that is something to keep an eye on. We've seen the unemployment rate really flatten out. So it's a concern. But in general, I mean, I don't know, it doesn't seem like a lot to react to here. So
you sound like somebody on the second floor of the Eccles building. You get to go into the room once a year. If you're a 28-year-old PhD newly minted at the Eccles building, what are you telling governors, presidents, and the chairman?
Well, if they were consensus, they can go in and say they nailed their forecast. I mean, really, getting something hard, like payrolls and going through the hurricanes and the strike, this is really more of an art than a science. And what they are trying to pull out of here is what is that underlying pace? What's the 3-month change? How are things going? And really, it looks like we're kind of back where we were before hurricane. So it seems to be giving a pretty consistent story of the slowing, but nothing real shocking here.
See how Dr. Sahm goes to the 3-month moving average. I mentioned that an hour ago.
Yeah.
I mean, Paul, that's the way we roll.
That's the way we roll. And Tom, I'll just note the revisions from last month. We were at 12,000 was the reported number, revised up to 36,000, just to put that out there. Dr. Sahm here. So if I'm the Federal Reserve, I have to feel like I'm doing my job. I'm not even pat myself on the back
That's
here.
That's a nice way of putting it.
Yeah. So do I cut rates in December, then just wait?
I think they've been doing this kind of look ahead, and this is very, I'm sure, consistent with where they thought the data were going to end up today, largely. And so they're on a path to have a cut in December to keep this pulling some restrictiveness out of the economy, doing it gradually. And I think this ought to support that. Now, the last roadblock to the December cut, which I think the Fed is very much on track to do, the last roadblock is next week's CPI. But even that, I mean, they've had a plan, they've articulated it.
Claudia, I've got to go. One final question to all the character of Michigan academics, and that is the study of inflation. Can we use our usual tools to study this modern inflation, or are we so overwhelmed by technology, its shift to productivity, that we can't measure inflation with the confidence that Ned Gramlich and company told us we could do?
Well, our statistics, the way we measure inflation or any other aspect of the economy, they're always evolving. Right? The Bureau of Labor Statistics is always bringing in new data, new tools. They're refining it. They don't, it's not the stuff of headlines, but we do have to keep up with the technology and the changes. And I think largely the U.S. statistical agencies do a good job. There's always more to do, but it does, it's fine to have more tools in the toolkit and that awareness. And we should have an awareness that no number that comes out, whether it is well crafted, is the truth. Right? These are estimates. This is our best estimate of what's going on.
Claudia, thank you so much. Claudia Sahm, New Century Advisors, all of her work at the Fed and, of course, of Michigan. As Paul mentioned this earlier, the revision is 12,000 up to 36,000. The sum 2-month total is 56,000. Positive revision. You add them together, 227 plus 56. I don't have the HP12C in front of me. I'm guessing 283 is a constructive number here to develop a 3-month moving average and to be thematic.
Yep.
That's a new word. We're thematic.
We're thematic.
Joining us now from Morgan Stanley, she's thematic.
She's writing a research note as we speak here, Tom.
She is. I mean, it's gifted. Thematic and macro investing. Sarah Wolfe joins us right now. That's my theme today. Forget about the noise. Grab a 3-month moving average. Is that what you're doing?
I'm looking at all the underlying details, and it's kind of just showing that the economy's in a solid place, and we're not going to see much market moving around this. We're going to look towards the CPI data, but the economy's chugging along. It's in a good place, so we don't need to put on more cuts for next year, and it's not so high that we need to take off cuts as well for December. If you look at the underlying trend, we're probably running at around 150,000 a month, which is a pretty good place to be right now for Powell.
I mean, I look at the wage number. Paul mentioned a tick better than we are. Do we have an inflation-adjusted real wage? Lisa Mateo questions that.
We're having real wage gains, that's for sure. If you get CPI data next week at 0.3%, then that's an increase in real average hourly earnings. That's one of the reasons why we see a little bit of improvement in low-income spending next year, because you're finally getting that real buying power back. Wages are now rising above inflation. We've been waiting for that to happen, and now we're starting to see it, and it's pretty sustainable.
Thanks to Eric from the back row here. Interest rate swap traders are citing an 82% chance of a rate cut at the Fed December 18th meeting. That's according to EJ Markets Reporter.
It's the same study that's guessing where Juan Soto's going, right?
Yeah, please. Who knows? The highest dollar. So, Sarah, if I'm the Federal Reserve, I'm calling soft landing, right? I mean, I think we got to give these folks some credit here.
Yeah, well, if you look at the underlying details, it's even better than the headline, because you're not getting an extraordinary amount of strength in these holiday shopping categories, which is where I think markets were expecting there to be more strength. So retail trade was actually down 28,000 on the month. Transportation and warehousing was a mere 3,000, so we didn't really get that big upside. That means that you actually got a lot more breadth in payroll gains. So financial activities were strong, professional and business services, more confidence in these white-collar jobs. And then we're still getting hiring at the lower end of the income distribution, education, health, leisure, and hospitality. So I do think that the breadth in the payroll print is notable.
She gets numbers that we don't get, Tom.
She gets it's
special
amazing.
numbers. I don't know.
Just so let me translate this, folks. If you're at a fancy firm, a white shoe firm like Morgan Stanley, it's leisure and hospitality.
Right.
Here at Bloomberg Surveillance, it's bartenders.
Exactly.
Okay, continue.
So, Sarah, I mean, as we step back here, I mean, in 2025, how are you guys thinking about this U.S. economy? What's your GDP outlook? What's your inflation outlook? Are you constructive, or do you have some concerns out there?
Yeah, so first let me talk about the labor market for next year, because we're here right now.
Yep.
If we're getting tighter immigration policy, you could actually start to see that unemployment rate push down lower, right? Because you're removing labor supply from the economy, and wages could go a little bit higher. So it's going to be an interesting dynamic next year where payroll growth could be quite a bit softer, because you have less population growth, somewhere to the tune of 50,000 to 100,000 a month. That looks weak compared to where we've been running the last couple of years, but that's still going to reflect a very tight labor market, because it's coming from the supply side. On GDP growth, we have about 2% for GDP, so that's a slowdown from where we are this year. Nonetheless, there's a lot less downside risk, recessionary risk, right? There's policy risk, but we're moving away from the recession risk, and that's one of the reasons why markets could be a little bit more optimistic, even with weaker GDP growth.
On your commute across America, good morning, and thank you for joining Paul Sweeney and myself. Apple CarPlay, Android Auto, thank you. Sirius XM channel 121. They showed me those numbers 2 days ago. Wow, thank you for joining. On Sirius XM on the quarter, 99.1 FM Washington, up to Mount Katahdin. A little chilly today on Mount Katahdin.
I bet you.
I'll check Mount Washington here in a moment.
Okay.
See if we can get a hot toddy at the Mount Washington Hotel. Good morning, 92.9 FM in Boston as well. What do we have upcoming here? We got Sarah Wolfe with us right now. Kathy Jones will join us. And then very importantly, an extensive conversation with Lori Calvasina on this great bull market. She's killing it today. Small stocks, Russell's up 0.9% here, more volatile than the others. Sarah Wolfe from Morgan Stanley with us right now. Where's nominal GDP? Where's the animal spirits next year? Are you telling me we get a sustained 5%, or do we dip down a little bit? Not in the lethargy, but we just finally pull it back.
I think we could start the year around 5 or 6%, and then it's likely going to...
Did you say 6?
5 to 6%. I mean, if we're still getting GDP growth at 3%, I think there could be a little bit of upside in consumer spending in the beginning of the year. Think about the wealth effect. That's going to start to come through in early 2025. We've had a really significant rally in equities, and that's going to pass through into some consumer spending, and you get a little bit of a rebound in lower income households as well. And then I think we start to get a bit of that slowdown with immigration policy, with tariffs, and so markets need to be watching that slowdown that could start to hit the middle to the end of 2025. And I think that the fixed income markets are definitely aware of that. Equities seem to be a little bit more excited.
Did anything change?
See how she did that?
I know.
She learned that from Mike Wilson.
Yes.
A little more excited is how you hedge that.
I know. Sarah, did anything change for you guys at Morgan Stanley from the economic and strategy standpoint? The day after the election, we now have a Republican president about to take office. The Congress, Republican, although maybe not as wavy as some people would think, but still a Republican-controlled Congress. Did that change your outlooks, your forecasts?
Yeah, our economics team definitely took up inflation a bit for next year, right? We had inflation coming down closer to 2% by the end of 2025. Now it's looking closer to 2.5% because you're getting that inflationary effect from tariffs. What that also means is that you have to take cuts off the table. Fed's not going to be able to cut that much next year. We have 3 cuts in our forecast. The Fed's likely going to have to take some cuts out of their forecast at the December summary of economic projections next week. And that's going to reflect higher inflation not only for this year, but they're also going to try to be modeling out the policies for next year in their own projections.
Right.
And it could lift up their expectations for inflation.
Tell me, one of the themes is we got a 3% GDP growth in China. Who knows? But the answer is it's a subdued Pacific Rim. You got NX off the back of the equation. When you say, here's our, as El Arian would say, here's our unknown unknowns, how unknown is the export dynamic globally, which, frankly, Morgan Stanley invented the analysis of?
I'll tell you what I'm watching the closest. It's what's going to happen with Mexico and Canada, because even though we have a lot of trade with China, we're way more exposed to Mexico and Canada. Our value chain, our supply chain is completely interlinked with these two economies. It's a quarter of U.S. trade to Mexico and Canada. 80% of exports from those two countries come to the U.S. So, of course, tariffs are being used as a negotiating tactic as we go into the USMCA, but if we really do see an increase in tariffs there, that's going to be something to watch, and that's going to really hurt U.S. manufacturing.
The uncertainty back end here is just amazing, because you take, whatever the math is on net exports is a percentage of total GDP. The consumer gets all the attention.
Right.
But I'm sorry, NX is not a small matter.
It's not a small matter.
Get one more. Kelvacita is waiting to come out.
I know.
Get one more.
One more. Sorry, we've got her in our studio here. So, Sarah, what's the headwind out there that maybe we're not thinking about? Maybe the market's not thinking about. Are you guys penciling out some concerns out there?
I would say the biggest headwind is that even though you're going to get an extension of the Tax Cut and Jobs Act, it's mostly going to be benefiting upper income households, right? And so you need to think about how much of that actually starts to pass through into stronger consumer spending. And I'm talking about 2026 now, right? A little bit further out on the outlook. Households tend to spend savings when you're that high income if you're getting $400,000 or above. So do we really get that much upside to economic activity?
In the old days, you don't remember this, C.J. Lawrence, Bear Stearns, David Malpass, John Roddy, whatever. In the old days, people like you would model out 36 months. The only thing I can model out right now for 2026 is Ellen Zentner's going fly fishing somewhere. That's the only thing I know. Can you really go out even to July of next year with any confidence?
We have to talk about all the uncertainties, but what I could say is maybe a near-term uncertainty. We're getting University of Michigan at 10 a.m. We've started to get a little bit more data on business confidence as well. The hope, right, is that now that we're past the election, we can start to get some animal spirits from consumers, from businesses. They could start hiring again. The biggest worry right now is that hiring's been slowing down for 2 years now. Can that start to stabilize? That's what the Fed really wants to see, and how big of the election play.
That's brilliant. Sarah, I got to get this in one more question then. If hiring has been slowing down for 2 years, why do I have a sub 5% unemployment rate? And the answer is what? Immigration in the unknown?
I mean, layoffs have stayed really low. You're not seeing hiring come down and layoffs pick up as we normally do, right? People are still retaining their workers. There's this uncertainty effect that's weighing on hiring, but it's not so bad such that people need to start getting rid of their workers.
Sarah, thank you. Sarah Wolfe with us here this morning with Morgan Stanley.